Talk about the banking earnings, what's on the table. Peter Sorrentino, Senior Portfolio Manager at Huntington Asset Advisors. Harry Rady is CEO and Portfolio Manager at Rady Asset Management. Gentlemen, good to have you on the program. Welcome.
Thanks,
Maria.
for having me.
So let's go through some of the banks that are out with earnings. There are a whole host of them, obviously, this week. Who do you think fares best and who is still going to be pressured, Peter?
Really, I think at this point in time, J.P. Morgan could surprise to the upside. Remember that they now own Bear Stearns, and I think some of that trading activity, given that it's a much smaller playing field out there, is really going to flow through and benefit them. I think expectations for Goldman Sachs may be a little overdone in here. I don't think that number will be as strong as people were hoping it will be. So
you're saying basically a hold rating on Goldman Sachs, but you think J.P. Morgan could be a winner. Would you be committing new capital to J.P. Morgan ahead of the numbers, and do you own that stock right now?
We do own it right now. It's one of the few financials that we actually have a buy rating on, and would, if I didn't own it in a portfolio, would be adding to it at this point.
How do you see it, Harry?
Well, this is the first time in 18 months that we've started investing in financials. And about 6 weeks ago, we bought the Ultra Financials, the UIG ETF. And we just think that there's still too much risk to take individual bets on individual companies. There's just not enough clarity on what's on the balance sheets of these companies. So we've taken a sort of sector neutral approach. We're long the UIG and we're short Northern Trust. Northern Trust is trading at 17 times earnings, 3 times book, and 21 times free cash flow. And we just think that limits the upside. So we're long UIG and short Northern Trust.
So we heard from the major consumer lending, basically the plain vanilla lending institutions, that business was okay in January and February and things were coming back. Although March was difficult given the trading activity. Would you buy into any of that, knowing that you did see some stability in January and February? How do you see the overall business tone right now, Harry?
I think that this is a bear market rally, and that a number of these names, Goldman Sachs, Morgan Stanley, a number of these stocks are up 300% in the last 4.5 months. So we're starting to look for short opportunities. Again, I think this is a bear market rally, and it could last for a few weeks, but we're gradually easing into increasing our short exposure.
What about that, Peter? I'm looking at a report from Standard & Poor's right now and Thomson Reuters to look at really what the earnings picture is going to look like. Financial earnings are expected to be down 49%. Do you think that's priced into the stock? I mean, we've seen a big rally in these shares over the last 6 weeks. I guess the question is it justified based on what we're about to hear?
Well, the stocks had gotten depressed to the point that they were really being valued as though they were at liquidation or below. This rally has been just bringing them back to going concern valuation levels. So in here, now the risk picks up, and I think the previous point is a good one, that we could definitely see some of these names have gone too far. That's why we've got Goldman at a hold in here. I think expectations are a little too generous there. The group is in secular decline. The consumer is clearly going to redo their balance sheet. So from this point forward, you have to be very selective in terms of what you're going to buy in financials if you look to make money on them.
And do you want to be differentiating the trading-related banks versus the consumer-oriented related banks?
Yeah, definitely. The chickens are still coming home to roost on the consumer. As long as unemployment deteriorates, we're seeing card write-offs begin to match up with subprime. Home equity is clearly now showing additional signs of weakness. So the consumer sector is just going to continue to erode over time. And that's an area that we think, you really want to be very cautious about exposure. The trading related, as I said, there are fewer competitors out there. So with the amount of debt that has to be issued and the very few avenues to raise capital anymore, the trading related banks could do reasonably well if they can avoid the credit risks.
Gentlemen, thank you. So good to talk with you, and we appreciate your time. Thanks, gentlemen. We'll see you soon.
Thanks for having me.
All right, we'll talk with you soon.